Hi, we're back, finally, with another episode. I'm talking about this entire endeavor of investing into Chinese stocks or Chinese equities. So I think as the title have already suggests, possibly that I've recently added to my Chinese exposure. I'll get into greater details in the later part of this video. But I think over the last 1 month or so, especially after that last week of September, where we are seeing a lot of meetings, announcements coming out from the Chinese government, talking about their resolve and their determination in trying to arrest the weak economic environment that China is in today. So it got a lot of long-time investors excited again because they are speculating some sort of stimulus that's never seen before, and that kind of liquidity, that kind of easing will probably help push Chinese equities to a new all-time high or new height. And it's especially needed after a 3 to 4 years long bear market. So I think for myself, reading into a lot of all these macro signals and macroeconomic analysis is not necessarily my forte, firstly. And secondly, I think it's really very hard to make an informed prediction, or even an informed decision when looking at things in many of these lenses about how GDP is going to be affected, how the companies are going to be affected, and long story short, what type of expectations is being priced into the valuations today. I think all these are too hard to comprehend. Even though I do understand that I made a few videos outlining my thoughts, but I've shared what I wanted to say, and I didn't want to continue churning around that topic. But I think long story short, if you look at the overview of my portfolio today, this is accurate as of 2nd of November 2024. And in terms of the weightage, China still makes up the majority. On a fair value basis, it still sits at around 58%, the US 39%, and Singapore 3%. My top two positions are, of course, your Chinese tech companies, Alibaba 35, Tencent 20. The third Chinese company that I have is actually Haidilao at 3.7%. And clearly, my Alibaba position that has been built over the last, 3+ years now, it's still in the red, while my Tencent and Haidilao that's accumulated much later into this whole bear market drawdown, they are comfortably in the green, at least for now. So what is that Chinese company that I added to my portfolio? I think, surprise, it was nothing new. It was actually an addition to my current Tencent exposure. I added on the 15th of October 100 shares at around $413.80 per share. So I think on a blended approach, I currently hold 600 shares with an average cost of roughly 315 Hong Kong dollars per share. I did update this move in my Substack on the 20th of October. It's a Sunday, I believe. And for those of you who have not been following me on Substack, you kind of get first dips there. So if you want a more timely update, understanding my real-time thoughts of the market, if I'm not updating on the YouTube channel, you can follow me there as well. I think the link will be in the description. But anyway, anyhow, adding into a existing position, I think it's not something surprising. I really do think that Tencent as a company, even after this recent run-up, and of course after this recent pullback as well, still serve as very good risk-reward opportunity, especially for those of you who are kind of comfortable with the risk associated when you're talking about investing into Chinese companies, and more so Chinese technology companies after this crackdown that is kickstarted at end 2020. So I did add in that piece saying that this recent addition is actually the highest valuation that I've added to my Tencent exposure. A lot higher, actually 21% higher than my first add. So the first time I added Tencent, it was around 341. The most recently, 413. It's a play of numbers. It's just purely coincidental. So I think when comparing Tencent in 2022 versus the past 2 quarters in 2024, I think there were strong signs of recovery and positive developments that might continue to surprise investors to the upside. So all things considered, I believe that Tencent still possess a good investment opportunity for those who understand its business, and I'm happy to share more. So, and here is the video that I've promised. So I think just to also add a little bit more color and context regarding this Tencent ad, we know that this is Tencent's price action over the last 1 month or so. So right after that, so-called pseudo-stimulus announcement, Tencent, from the recent lows of around $370 per share, it shot up straight to $480 per share. And right after now, it kind of bounced at the 50 moving average, and it's consolidating within the $400 to $430 range, which is where we are currently at. So this huge bounce and then this retracement, it's kind of expected, because if you really look at this thick green bars that happened, it was just pure momentum, pure excitement. There were a lot of FOMO. There were a lot of discussions online saying that you shouldn't miss this out because the Chinese government is here to pump your backs. But I think those jokes aside, it has been one of my, I guess, philosophy where whenever I want to make a particular decision, whether it's a buy or sell decision, I'll try to hold off that decision for 2 days at least. So after 48 hours, I'll sit on that decision and think about it. And if I really want to sell or want to buy more, and I'll wait for that 48 hours to be over. So I'll feel more calm and emotions don't take the driver's seat. So I think in that regard, I think I did fairly well, considering the fact that from the end of September, so with that so-called quote-unquote stimulus announcement, I'm actually held off for 15 days or 2 weeks to be exact in order to make that first move touching any of these Chinese stocks. Because I believe that a lot of all this excitement has kind of wear off. At least that's based on my own opinion and my own judgment. So I don't have a lot of opinion on this whole macro conditions, how you're going to trade it. If that's your thing, please feel free to look for another creator. But for myself, I like to look at it from a bottoms-up approach. And I think at least based on my previous Tencent analysis, they usually revolve around earnings development. And I haven't really been talking about Tencent's business from a fundamental, from a qualitative, from a quantitative perspective. So I guess that's the main gist of today's video. Let's look into Tencent's business, how they've been doing, the numbers that they're putting out, and why I think that there's still a great opportunity today. Of course, none of this is financial advice. I'm just helping you with my own research and my own process. So of course, first things first, when we look at any company, we always look at the top line, which is the revenue growth. And this is the revenue growth trend of Tencent over the last 10 years, I believe. I put out the revenue, the absolute revenue number from end of December until the last quarter that they reported, which is June of 2024. And you can see that actually pre-2021 or 2022, they are in a very, very nice uptrend. And like most tech companies that you see in their US counterparts, you pull out any revenue graph, whether is it Google, Microsoft, Apple, Meta, and I guess it's naturally the characteristics of great companies. I actually do believe that Tencent is really a great company and they are able to rival many of your Magnificent Seven companies. Even though I believe the share price might say otherwise, and many investors, when just looking at the share price, might discount totally this company. But let me just share a little bit more. So I think in this time period, between 2022 to 2023, they did experience some sort of a flat or even negative revenue growth rate. And I think the context is important here, and just put a pin or put a note here at the back of your mind. And we will talk more about what happened in 2022. And so I think going into the growth CAGR, you can see that this is what we are basically talking about. Really high growth rates actually pre-2021. You can see that they range between 25 to even 50% year-on-year CAGR growth. Then in 2022, something hit them. They were flat or even went through the negative territory. And right now, I guess we are not here, not there. Meaning we are not very high growth. We are not going back to the 20% year-on-year, but we are also not at flat or negative growth rate. They are posing, I guess, roughly 8 to 10%. So is this what we are going to be expecting? And I think the biggest question for many investors' mind is that, are we able to return to former glory of the 50+%? Or will we at least go back to 20%? Or is this going to be the new normal where it's a matured tech company that is too big to fail, but at the same time, they don't have a lot of growth curve or expectations moving forward, and they're stuck between that 6 to 10% growth rate. So I'll talk more about that later. So in terms of margin trend, I think they all share a similar story, even though I guess in terms of a gross profit margin profile, they kind of slowed down in 2020, picked up in 2021, go back down in 2022 again. But I guess you need to pay closer attention to the y-axis where they show the percentage. Actually, the margin is not a very big jump. So it's between 45% to 55%. You can argue that it's a big jump, but I guess it's still generally a tech company. It's a software company. They offer great products and services that people are willing to pay for with not a lot of COGS, which is cost of goods sold. That's why they're able to print out 50% gross margins. On a net income margin perspective, I think it's a lot lower, at least based on the last 3 quarters alone. They are closer to 20 to 25% compared to the 35-40% that they produced over the last, I guess, 5 to 10 years or so. But from a net income perspective, I think there's one nuance here that you need to take note of, is that Tencent actually do have a sizable investment portfolio, and they have to write up and write down their investment wins and losses. So looking at net income might not be the most accurate and effective way in determining their profitability, but I just put it out there for your own reference. Moving on to their profit trend. So this is their EBIT margin, earnings before interest and tax. And you can see that we are in this very, very nice recovery after the 2022 slowdown to the lows of roughly 19% margin. And right now, at least the last 12 months, they are sitting at roughly 30% EBIT margin. Moving on to the free cash flow profile, you can see that on the last 12-month basis, free cash flow, Tencent is actually sitting at the highest record trailing 12-month free cash flow. So you can spin any story and any narrative you want, telling me that the Chinese government is cracking down, they're destroying Tencent, they're destroying all these tech companies, they don't want them to survive. But clearly, at least from a quantitative perspective, looking at the numbers, we've never been better. And of course, on the flip side, looking at free cash flow absolutely, on the absolute level, might be misleading because we know that some of these tech companies are notorious in terms of printing shares based on share-based compensation that doesn't hit into their cash flow. But I think even on a free cash flow per share basis, on the last 12 months, Tencent is also sitting at its highest ever recorded free cash flow per share. Moving on to the business updates, I think this is clearly the most important slide in the earnings presentation, where you see the different business arms and I guess verticals outlining to you what's the most important thing. And clearly, I think from this cog, you can see that there's a lot of smaller cogs that are important, like games, digital content, utilities, cloud, fintech. They're talking about they are number one in users, number one in revenue, number one in paid subscription, number one by monthly active users, number two by revenue, number one mobile community, etc., etc. But if you really look at this infographic, actually there's only one key point to take away, which is the biggest wheel that is driving this entire engine. And it's really this blue wheel here, denoted by communications and social network. And long story short, in terms of the product itself, it's actually QQ plus WeChat. And these two, which is here, Weixin and WeChat and QQ, they drive the entire economic mode and business competitiveness of Tencent today. And I'll talk more about them later on. And if I may summarize, what is Tencent exactly doing? I think Tencent is actually in the distribution and in the data business. So I think for a more global audience, for people that don't really understand what it entails, why is WeChat so powerful, I think just to give you a flavor in terms of the different business offerings and how to draw comparisons and parallels with the US counterpart. So you have WeChat and QQ, which is basically something like a social messaging. It's like something like social media. You have some sort of a story or moments. You can share things with your friends, with your family. You can, in Chinese they call it 拉朋友圈. You can get people into groups. You can talk to people. And I guess they really monopolize the entire Chinese digital infrastructure and ecosystem today. I think if you want to stay there long term and if you want to communicate to local people and you want to really tap onto the entire ecosystem, you need and you must have WeChat. It's not necessarily the same, especially for people in the global or the rest of the world where people are thinking, oh, if I don't use WhatsApp, I still have Telegram, I still have Signal, I still have Messenger, I still have iMessage. That doesn't work or that doesn't fly in China. You need WeChat. There is no close alternative. Maybe for those that have global contacts, yes. But if you really want to be based in China, you need and you must have WeChat. And it's very comparable to your Meta's family of apps, in all housed in one, which is something like a WhatsApp, a pseudo WhatsApp, a pseudo Instagram, a pseudo Facebook, a pseudo Messenger. And that's basically what WeChat and QQ is. But actually what's very powerful about this whole WeChat ecosystem is really their ability to power up and to distribute to that 1.2, 1.3 billion people in the network and to just give access to whether is it competitors or actually I should rephrase this, or to deny access to competitors or to give to ventures or give to companies that they favor that distribution network, and more importantly also to harvest that data back to make data-driven or data-informed decisions. So I think also with that vast amount of real estate, that vast amount of attention, they then have some sort of a pseudo Google Ads network that contribute very meaningfully in terms of their revenue pie when you talk about trying to advertise and trying to get capture this kind of advertising dollar. Moving on, you also have something that is pretty familiar or at least very famous in many, I guess, even if you didn't go to China, you will know that it's a duopoly in terms of their payments, infrastructure and system, a duopoly between Alipay and WeChat Pay. And in this case, if you were to merge the fintech solutions that they offer, that they do is something like a pseudo PayPal, Visa, Master, or even something like a small or mid-scale bank. More importantly, of course, they also have their Tencent videos and music, which is something like a subscription basis of Netflix plus Spotify. More importantly, Tencent is also one of the biggest distributors of the game network out there. I think they are first or ranked second in terms of the largest gaming exposure and geography. They have your Honor of Kings, League of Legends, PUBG, and Call of Duty. For those of you who don't know many of these acronyms, just probably means that you're not a gamer. But yeah, they are the largest game distributor, basically something like a Sony or a Nintendo, under the Tencent umbrella. They also have a portfolio of companies and investments, and at least based on the last quarter, the amount that they disclose in their financial statement, based on carrying value and the book value, is roughly around 125 billion US dollars. And you can see them as some sort of a mini Berkshire Hathaway under the Tencent umbrella. And I think going back to the point of the data business, why are they in the data business? It's really having that acute sense of being able to harvest data, and just getting the data into your network is not good enough. You need to make sense of it. You need to be able to earn a return on capital on that. And I think through many of these case studies that I've seen over the years, understanding how they develop their games, what kind of companies they invest in, a lot of all these are so-called, I guess, venture capital in nature. You can look at it as some sort of a hedge fund, whatever it is. I think they're able to know what consumers want, and they're able to make strategic bets and to place and to earn a good return in terms of their capital allocated, and then allow for all these multi-baggers to take place. So I think this is where the unfair advantage is. You can think of it as, hey, Berkshire is able to deliver that sort of great returns, probably because of the insights and of a great investor. You can tap onto the minds of Charlie Munger and Warren Buffett. But I think in Tencent's case, not so much in terms of the management. Yes, the management is important, but it's really the ability for them to gather the data and make sense of the data, and to front run many of their competition, and of course be able to distribute it out to the mass public, and to, I guess, just garner support and favor people that they support. And that's why China as a market, you can say that it's very unfair, but that's how the game is being played, especially with this super app on your side. And of course, last but not least, I guess you have your potential AI and cloud development, which Tencent is always at the foreground doing things, but it hasn't amounted to much yet because we don't have great amount of insights or breakdown from there. So this is Tencent in a nutshell. They're doing everything software. I guess it's just the circumstances and the series of business decision that allow them to entrench their moat effectively in the entire Chinese infrastructure digital ecosystem today. So while doing my research, I've previously came across this Substack article by Pecky under Not Boring publication, where they basically outline the Tencent's business and investment opportunity. And this was back in August of 2020. And it was probably near the highs before the entire tech crackdown. But I think he did a pretty fair job in terms of outlining the business and outlining the entire investment thesis. I just wanted to point your attention to this very interesting infographic that I extracted here, where they are basically outlining the capital plus traffic flywheel that Tencent have going on with their business. So like I said, in China today, you probably cannot find someone that is not using WeChat, and they have this natural traffic funneling coming in from their top of funnel, basically the WeChat ecosystem, where everybody's messaging each other and using it as a form of social media. You have 1.2, 1.3 billion people coming in, and they basically attract aspiring companies to build on WeChat or even partner with Tencent to enter into China, which attracts more capital. And with this capital, Tencent can see who's doing well and invest in the winners. And then Tencent sends more traffic to the companies that they invest in, and Tencent invests more by maintaining its stake or buys and consolidates them, creating more traffic and capital. And this is the very interesting flywheel that we have going here. And I think just to add an additional note here is that I believe Tencent has already outgrown many of their partners. Kind of give you a flavor, back in 2020, you have a lot of discussions about metaverse, and we know that it might be a very great idea, but it might be a little bit too early, and not a lot of developments have been going on there. So sure, I think in this very complicated infographic, you can kind of figure out what is Tencent's stake here in the metaverse, especially with all these e-commerce ride-hailing platform, a lot of all these games, a lot of live streaming, a lot of social media, but I think it's still maybe a little bit too early. And Tencent is not necessarily the only one that is in this whole metaverse thing. I think the other company that I follow very closely, Alibaba, they are also quite into this whole AR, VR space itself. So yeah, I at least for now, I don't believe anyone has a monopoly there yet, especially for many of these very nascent industry that requires a lot more R&D moving forward. So just moving into the financial highlights, now after understanding the business itself, let's try to understand a little bit more in terms of the breakdown of the revenue. How does Tencent actually derive money, profits, revenue? So looking at the most recent quarter of 2024, you can see that there's a few bolded categories. And I guess those are the main pillars how they like to classify the revenue sources. So you have value-added services, you have online advertising, you have fintech and business services. You can probably ignore others because it's not consequential. So out of 160 billion base in RMB, I think it's good to look into Tencent's business as 3 1/3. And it's a rough estimation, it's not exact, but you can roughly understand where I'm coming from. So 161, I guess if you divide by 3, just doing some quick math, it's probably closer to 54, 55 billion. So 55 times 3, 50, 150, and 165, thereabouts. So you have around 50 plus billion as a 1/3. So the first 1/3 that I want to draw your attention to is actually the gaming division. So I did say that Tencent is one of the biggest gaming distributor on earth today, or maybe the second largest, behind something like Sony or something. I'm not too sure what the numbers, but looking at the domestic and international games, you add these two together, 34 plus 13 is 47, 48, roughly 49. So the first 50 billion, that's in the gaming part. The second 50 billion is actually the fintech and the business services part. So this is the other 50. And the third 50 is actually if you combine social networks, which is 30, plus online advertising, which is another 30. So this kind of makes up a little bit more than 1/3, but you'll get where I'm coming from. So 3 different divisions: gaming, fintech, and also advertising plus value-added services. So this is basically my own Excel, and I kind of break them up into their own individual line items, and I wanted to see the growth rates of the different categories. And I think just a very intuitive rundown, you can probably guess what does domestic and international game means. Basically, it's just whether it's distributed in China or outside of China. But how do you earn money from online games? Whether you earn it from subscription, you earn from in-game credits, you earn from gachapons, whatever it is, they have many ways for them to extract money from gamers, and I don't think I have to explain more. But so yeah, that's the first 1/3. And I think the second 1/3 that we want to focus our attention on is really the idea of fintech. So fintech is not necessarily just Weixin 支付, which is Weixin Pay or WeChat Pay. So that's true, that's just one part of the revenue. But on top of that, WeChat also have their own wealth management business, which is why I say they're kind of comparable with something like a pseudo small to mid-sized bank, where they offer, I guess, your money market funds, your insurance, and stuff like that. So they are able to take a commission or to be able to protect people, yet at the same time invest the money. So that's really the fintech and business services part. So on that front, I believe they also kind of house the cloud division there. It's not as transparent as we hope to, but that's generally what's under that fintech arm. Last 1/3 is really online advertisement plus social networks. So I think for online advertising, it's quite intuitive as well. If you look into companies like Meta Platforms or Google, they basically monetize the real estate, the attention real estate, where they're able to keep you on their platform. You're using their social media, their messaging, their WeChat mini programs, and they just have a effective advertisement architecture at the back end for merchants to be able to enter their content, to be able to monetize, to have that whole end-to-end suite, to be able to gather new leads, stuff like that. I think that's quite self-explanatory. I think in terms of social network, that one is a little bit more trickier. We also don't really have the exact breakdown, but long story short, I do believe that it's kind of in the realms of subscriptions for their videos and musics and like in-app, in-game purchases, and they also kind of have some overlaps in terms of their advertising revenue. So that's generally how you look at the different business verticals. And I just wanted to highlight, I guess it's quite obvious where something will jump out at you, where you can see that these 3 particular columns here, which is in the year 2022. And I've clearly highlighted or demarcated here. I'm saying that I'm not too sure if you guys still remember. I think specific to Tencent, the Chinese government or regulators have introduced something like a new regulation where they say that minors cannot play games for more than 3 hours per week, and they try to restrict their in-app purchases, etc. And you can see that the time spent by minors, as disclosed by Tencent, decreased by 92% year on year, and it constituted around 0.7% of domestic time spent. And you can see just within these 3 quarters, a lot of their business segments suddenly turned into the red. Generally, the value-added services portion went into the red. Domestic games also went -1, -7, -6. International also slowed down. Social networks, -1.7, 1.7. And most importantly, I think especially in this 2022 year, online advertising took a very, very big hit. -12, 17, 18% CAGR year on year. Fintech, I think they were having a flat year on year kind of growth comparables. So I think 2022 was really a very trying and very tough year. Whether you can look at it from an economical front, which is you can say that, oh, the macro is slowing down and then that's why advertisers are not spending. You can look at it from that perspective. Secondly, also not to forget that in the context of China back then, they actually handled the pandemic pretty well in the earlier part of the 2020s. I think in 2021, they kind of kept let loose and they were able to show to the world, and they were very proud of it, that they were able to combat the pandemic. And I think 2022 came, early 2022, they know of the Omicron variants, and suddenly everything started tanking again, and they had to go through very extreme measures, which kind of harmed a lot of consumer outlook, sentiments, business outlook, confidence, etc. And that's why I guess a lot of things, it's a confluence of factors that caused this slowdown in 2022. And of course, with the regulations in place, technology crackdown, anti-competition, it's not a very pretty picture. And it's kind of also reflected in their earnings, in their quantitative numbers. And that's why you see that huge drawdown, especially also when you look at the price chart in terms of price action. Tencent also suffered a very huge drawdown in 2022, 2023, that area. So sometimes, even if you don't want to believe in technical analysis or don't want to believe in how the market is trying to price in with imperfect information, just by looking at price action alone, they will kind of front run a lot of all these investors' expectations, and it will reflect into the numbers sooner or later. So now, after understanding the entire business and where we are at, I guess moving forward, you're probably in either one of two camps. Number one, you're either optimistic like myself, you think that we can recover, maybe not to their all-time highs or to their glories, but recover from a business fundamentals point of view, where they are able to write a new chapter, turn over a new page, this whole regulatory crackdown thing, it's done. We can grow from here on, and they are able to reap the benefits or rewards of the Chinese economy again. Or secondly, you think that this might be a new normal, a lot of this uncertainty coming from the Chinese government, you think that they're unable to grow even 10%, maybe it might be a flat business year on year for the foreseeable future. And this will really impact the valuations that investors are willing to pay. Because naturally or intuitively speaking, high growth, you are willing to pay high value. If low growth or even negative growth, then it might potentially be a value trap. And it might even be expensive today, regardless of how big the drawdown is. So I think just looking at a very vanilla way of looking at company valuations, a lot of people like to use PE ratio, which is price to earnings. Looking at the last 12-month PE, they're currently around 24 times. Looking at the next 12 months, which is something like a forward PE, they're sitting at 16 times. So if you were to really look at it from a historical point of view, relatively speaking, over the last 10 years or so, I think we can agree that Tencent is trading at a lower side of the valuation. Maybe not on the trailing 12-month basis, but at least in the next 12-month basis, you can see that analysts, in terms of their projections, we are sitting at probably close to their lower rung or close to their all-time lows. Minimally, at least based on my own understanding, you can see that Tencent has always used to trade around 30 times forward PE. Right now, they are trading at 16 times. So if you believe that we can go back to their past expectations or how analysts or how investors are feeling about the company, it's probably a clear double from here. That's purely from a PE point of view. Now, moving on, there's another way that we can to value this kind of so-called semi-growth companies using PEG, which is price earnings divided by growth. But I think one very important caveat or nuance here is that a lot of all these growth estimates is done by analysts that is sitting from the ivory towers. Maybe they might have insider information or they might have greater insights, but a lot of all these growth expectations can be easily tinkered with and can be easily changed. Immediately after, maybe the Chinese government suddenly does something crazy again and the earnings growth is expected to collapse, and that's when PEG just goes to the moon, which is bad in this case because you want to buy companies that are cheap, you want PEG to be as low as possible. And if it's below 1, that's the best because they think that anything under 1 is probably cheap. And you can see that just based on different expectations, it becomes very, very volatile because it's primarily based on growth expectations. So I think just looking at it now, the PEG ratio, based on current estimates, analyst consensus, PEG is at 0.78, also one of the lowest. So despite this so-called recovery from the lows of the pandemic or even the previous election scare in 2022, you can see that actually we are still, even after 150% increase from their lows, we are still at least at the bottom rung of the valuation, on a relative valuation point of view. Now, moving on to EPS estimates, I think to many of these analysts on Wall Street, it's just a change of the button in the Excel. So take it with a pinch of salt. At least you can see that there's a very positive revision to the upside in terms of the forward earnings per share expectations. Now sitting at roughly 20% from the lows of 6, 7, 8% just 2 years ago. But yeah, just keep in mind, these numbers can be very fickle-minded and analysts can change their projections anytime they want to. Moving on to comparable valuations, I think I just wanted to benchmark Tencent to many of these other Chinese tech companies that are people that are probably familiar with as well. So if Alibaba in purple, Pinduoduo in orange, JD in yellow, Baidu in green, Meituan in red, and NetEase in dark blue, and Tencent is in this light blue color. So Tencent, you can say that if you exclude Meituan, because Meituan is still considered a growth company that is growing 20 to 30%, the rest of them, I think they're still suffering from this compressed in valuations because of this whole scarring from the Chinese tech crackdown episode. And I guess also really in terms of a business quality point of view, I think that Tencent do have one of the best business qualities. That's why investors are willing to pay a premium. But I think that said, I think a lot of my points still stands. I still do think that Tencent is still considerably inexpensive and even, I may argue, very attractively priced today, even after this run-up. Now, in terms of a price to free cash flow basis, last 12 months, it's trading at 16 times, but similarly, painting the same story, dragging out to the last 10 years, they are probably closer to 30 times price to free cash flow. That is the normal, quote-unquote, expectations of investors. So today at 16 times, it's still at the lower rung of where Tencent used to be trading at. Now, looking forward in terms of an absolute point of view, meaning I want to derive the valuation of Tencent. So they're currently valued at roughly $500 billion US dollars, and their current assets roughly nets off their debt, which is also why their enterprise value is also roughly in line with their market capitalization. So they have an investment portfolio of around 125 billion US dollars, and their last 12-month free cash flow is around 30 billion US dollars. So the first basis that we can do is, of course, try to get a more reasonable free cash flow multiple and multiply it to the existing free cash flow that they generated and see what is a comfortable market cap that we are willing to pay. So going back to that free cash flow graph, I did say that 30 times might be the median, but I think just to take a more conservative estimate, I think 25 times is already on the lower side. So it's not median, it's lower than median. But let's say 25 times is the fair multiple to pay. So 30 billion times 25, you get around $750 billion in market cap. And that means at a $500 billion today, you have 50% upside from here. Now, moving on from a yield point of view, if we were to take $500 billion, netting it out of their investment portfolio, and they give many of their equity positions to the investors, probably buying Tencent at a $375 billion valuation. So if I were to use 375 divided by 30, that's around 12.5 times. And if I do 1 over 12.5, that's around 8% free cash flow yield. Every year, and of course not accounting for the fact that free cash flow will probably grow from here, and 8% is the baseline expected yield moving forward. And I think holding it out for the next 5-10 years, you can probably expect this yield to hopefully double in years to come. So then the natural question that you want to ask yourself is that, what is a comfortable yield for you? At least for now, if you benchmark it to the, I guess, general 10-year bond risk-free rate, at least in China today, I think the risk-free rate is closer to 3%, 2 plus 3%. Even if you benchmark that to the US 10-year yield, 4 plus 4.5%. So looking at an 8% free cash flow yield, assuming that Tencent is going to return you all the free cash flow every year after doing their business and able to return you all the equity positions that they have, I think it's still comfortably double again from current valuations, and you are getting it at kind of a steal. So that's from a yield point of view. Lastly, I think if you were to look at it from a DCF or intrinsic value calculation point of view, I did this bottom baseline assumption where earnings growth will be 10% per year, or at least earnings growth will be translated to free cash flow growth, and not forgetting that EPS, at least for the next 5 years, people are expecting 20%. Let's just take a haircut to be conservative. 10% per year growth, free cash flow, 5 years, 20 times exit multiple. Even though we say that the more natural or the more expected number is 25 to 30 times, let's just use a 20 exit multiple, a 10% discounting rate. The intrinsic value calculation works the valuation out to be around 720 billion. So it's still 44% undervalued. So you have a range of numbers coming out. 44% undervalued, you have 50% upside, you have double. So what is the actual fair value of Tencent today? The short answer is I can't give you the right answer because there is no right answer. But I think just considering Tencent's business model, really the effectiveness of the business execution, the business decision, and how they're being priced today, I think it's still fairly inexpensive for buying such a high quality business. Now, of course, like any business, there are always risk factor. I think competition is probably always at the back of the mind. For many of these tech companies, it's always day one because everyone is trying to carve out a share of their own. And for those that are very familiar in the tech scene, one day you might be at the top of the hill. The next day, you probably can't even find the hill. So I think growth expectations moving forward, at least for now, is being subdued, especially with the recency bias of the tech crackdown in China. And growth will pretty much be linked tightly towards China's prospect and development and how they're going to recover from here. Because let's not forget the first 1/3, which is their gaming revenue. You can argue that international gaming revenue might be less reliant on China, but a large part still is derived from domestic games, which then also relies on whether people are happy, excited, confident about their future to be spending a boatload amount of money in games. Secondly, you have your online advertising. People or merchants have to see a return on their ad spend. And if consumers are not confident in spending money, they don't see that return on ad spend, they will then size their advertising dollars accordingly. And of course, you have a lot of these expectations around subscriptions, around Tencent's ability to take a blanket tax, something like similar to an Apple store, about all the transactions taking place on their platform. So a lot of all these things are still tightly linked to what the Chinese economy and the Chinese people are doing. So yeah, that's the second point. And the last part also is that I think WeChat, like I've spent a large part of my time describing, which is the main driver of their competitive advantage. I think in my very humble opinion, I don't think that it would be another application that would disrupt WeChat. Because I think over the last 2 decades, I think there were a lot of different juggernauts, could be tech, could be non-tech, trying to give it a go, trying to disrupt and trying to have an alternative. But they've all since failed. So in my personal opinion, I think the main driver of being able to disrupt WeChat is an entirely different mode or model of communication, which is black swan in nature, because it's not something that we can see or we can touch right now. So at least for now, I think my base case assumption or my expectations moving forward is that Tencent is able to maintain their mode. WeChat is still the strongest and most competitive application out there, and I don't see any competition in the horizon. But that being said, I don't think that we should be complacent and say that WeChat will never be disrupted, because I don't think in the business world anything is forever. So I guess we have to keep our eyes peeled, but for now, this is something that you probably want to take note of. Now, moving on, I think in terms of the regulatory cycle, they tend to move in loosening and tightening cycle. Right now, I do think that they are in the loosening phase. We see that they are trying to turn a new chapter. The government is also using a lot of positive signals and posturing. You need to ask yourself that, do you believe that the business has already been fundamentally impaired? Meaning to say their growth or prospects are being vastly different compared to pre-crackdown? And if that's the case, past valuations are not applicable. Or do you think that Tencent as a business is no longer viable due to the uncertainty of the crackdown and government regulations? And if that's also the case, then you'll probably want to stay far away from them. And if the answer is no, I do think that there's a pretty great investment opportunity here. So my bottom line is this. I think if you want to compare to the past glory of these tech companies with sky-high growth rates of 50, 60, 80% CAGR and inconceivable margins of 50, 80% in the early 2010s, I think you might need to reconsider. And I'm not saying that it might or might not happen, but clearly the market is not pricing in this baseline assumption. So it's also a function of size, because a lot of all these companies, specifically in the tech realm, they kind of already 5 or 10x in the past decade. And it's also a function of market expectations and saturation. Unless they're able to break new markets. But for now, I think at least for both Tencent and Baba, they've been groundly, very strongly rooted in the Chinese markets. They tried to break out, but I think to not much avail, even compared to ByteDance, TikTok, or even Pinduoduo that have done with greater success. So I think even though it seems like the US Magnificent Seven seem to be able to buck this trend, despite that 10x in the last decade, they're still able to grow 10, 20, 30%. Which is also kind of reflected in their valuations and expectations. So this is kind of the risk reward and the formula that you have to keep at the back of your mind when you're looking at these two different monsters. That said, I think that there are still potentially new growth curves waiting to be discovered and developed, and who knows what kind of companies will they become in the next decade. I'm particularly bullish after this tech crackdown episode comes closer to a conclusion, And as China sets their eye onto the next high-quality growth pursuit, especially into nascent areas like cloud, Internet of Things, big data, internet, AI, robotics, smart manufacturing, AR, VR, so on and so forth. And I know that oftentimes these names or these terminologies are being thrown out as a zinger word or as a buzzword to make your company feel more important. But I think that probably works in the startup space. I think specific for many of these Magnificent Seven, or even in China, your BAT, ByteDance, or Baidu, Tencent and Baba, actually a lot of all these developments and innovation is already at the bedrock of their entire ecosystem. So it's not the first time that they're doing AI. It's not the first time they know that, oh, I can use something like that to amend or to tweak around my algorithm, or to help with content marketing, or to help with advertisers. It's completely valid for them to talk about them because they are technology companies that are powered by many of these new growth pursuits. And for myself, I really do wonder who would be at the frontier of these focus points, if not for mainly these two companies that I follow. So I think things remain to be seen, and we don't know how things will play out, especially when many investors are scarred from the previous so-called restructuring and regulation. But I still think that Tencent is still one of the best businesses that I've seen thus far. And of course, if this is also one of the best videos that you have seen on Tencent thus far, please feel free to smash that like button. And with that, I'll see you guys in the next video, and more importantly, I'll see you on the moon. Goodbye!